Hello, friends. Today we're talking about the Travelers Company, ticker symbol TRV. This is another suggestion from our viewers. I really appreciate these suggestions, and we'll be looking today at the stock performance in the past couple of years. Then we'll jump into some of the earnings reports and the upcoming earnings report, and we'll look then at the last 10-year fundamentals and try to find a fair value for this company. Welcome to Money Talks with Martin Reyes, where we learn to take care of our money and find great companies at great prices. So the question is Travelers Company a great company? And it's so that I don't own this company. This is I'm just gonna tell you up front, is a insurance company which I am having a hard time in some areas to evaluate, and so I will need to dig a little bit more, and I will encourage you to dig a little bit more. If you have some comments on this company, I'm interested in this company. I would like to buy it, but I need to do a little more digging. And what I will ask you, wonderful community of mine, is to give me your thoughts. Put them down in the comments below. Correct me in anything that I may say mistakenly here, or if there is areas that I need to kind of take under consideration when I'm analyzing this company, or anything that I should be paying more attention when I'm reading the 10K or the 10Q. Just let me know. Okay. In the last 5 days is flat at 0%. Last month is up 2.8%. Year to date is up 14, almost 15%. Last year up 23%. Really nice rally. And then the last 5 years it's at 66%. The analysts consider it a hold, and part of the reason is because they think that the next 12 months target price is $200, close to $200. So right now it will be $18, $19 above that price, which will make it the target price will be negative 8.7. Earnings are going to be reported on April 17. Ex-dividend was this past Friday. They pay $4 for dividend, which is close to, at this price, is 1.83% dividend. PE ratio right now stays at close to 17 times earnings, and the forward PE is lower. I always like to see the forward PE lower than the PE, because it means it means that the earnings are growing. So that this is a quick way of looking at that. So forward PE is close to 12 times earnings. When we jump at the earnings, the last earnings they beat, and they beat substantially. Last earnings was on January 19, and they beat by almost $2 in EPS, whether it's normalized or GAAP. And the EPS for the quarter was close to $7. They also beat, of course, on revenue, on almost $26 million. Revenue was for the quarter was close to $10 billion. Analysts are expecting on April 19, whenever they report again, for their EPS to be a little lower than what they reported last time, at close to $4.80, and revenue actually be higher at $10.18 billion. When we look at the projections, revenue are projected to continue to grow steadily, and EPS, it's very interesting because they are looking for a huge jump on 2024, and then another kind of nice jump on 2025. So we're looking at, the estimate was 11.17 on 2023, almost doubling by 2025. So this is a very interesting company. to be honest. And that's why I would love for you to let me know what you think about this company. So um, I would love to hear what you have. Leave me your comments. I encourage you to subscribe and leave a like if you like what I am sharing with you. When it comes to revenue, we look back at the last 10 years, and it has been growing pretty nicely at a little bit above 8%, whether you look at the 5-year average or the 10-year CAGR. Um, Gross margins at a 40, close to 40%. This is one of those numbers that I will need a little bit more investigation to understand. Is this a good number for an insurance company? I know how to analyze a bank. Insurance is a little bit different because I know in banks, deposits are liabilities and debt that you lend is assets, and I don't know how the insurance companies work. So if you could write down a comment and help me with that, or point me at some other videos, I will really appreciate it, because this seems to be a really nice company, a company that is growing their revenues at above 8%, above market. That's really nice. Earnings are a little flat in the last 10 years is at 2. The last 5 years is a 5% CAGR. Profit margins are really low at 8%. However, free cash flow, this is what it caught my attention when I jumped from here, earnings, to free cash flow. That is the part that I'm trying to understand. I don't think an insurance company are doing a lot of capital expenditures. So I'm just trying to figure out what's going on in here. So they have been growing it. Cash flow has been growing really nice. In the last 10 years at 11.9, last 5 years almost 11. Free cash flow margins at 18.6%, not too shabby. And this is when I saw it. This is where I was like, what? The free cash flow yield, it's a 17.7%. This is the highest free cash flow yield that I have seen on any company that I have analyzed, honestly, either on my own since I started paying attention to it or in this channel. Normally I would be happy with a 6. 6% would be crazy. At 3% is awesome. 4, 5%, 17%. That is just, I don't know. I don't know what to do with it. Book value. This is another thing. I don't know how book value applies to insurance company, because normally, when you're talking about financials like banks, you look at a book value. It's a number that you really want to pay attention, because the saying goes, buy at 1 and sell at 2. So you buy the book value whenever the bank is at book value 1, and then you sell it whenever the book value is double at 2. So that's what they normally say. And I know that, for example, with banks, if this was a bank, return on asset at 2.4, that is great. You want it above 1. Most banks have a return on asset that is under 1. So 2.4, that's great, but I don't know if that's great for a financial, like insurance company, or whether it's or it's a horrible number if it's just a regular company. Book value has been growing in the last 5 years at 6.7%. Last 4 year at 4. Let me know what you know about insurance companies. Return on equity, pretty nice, 12% average. Return on invested capital, a nice 10. Nothing to go crazy about. When it comes to the dividend, has been growing steadily in the last 10 years at 6.2, and in the last 5 years at 4%. Payout ratio pretty low at 7.5%. There's no risk of the dividend going away. Long-term debt has been growing at 6 point something percent, whether it's the 10 or the 5. So long-term debt can be paid with a free cash flow average in a year and 3 months, something like that. So I'm not worried about their debt level. They have been buying their shares aggressively, I think. They have slowed down in the last 5 years. So if we look at the 10 years, they've been buying at 3.8% of their shares, which is pretty nice. And then when he goes to the last 5 years, that will be at 2.4. So it has slowed down. Here are all the numbers together. If you want to take a look, most of those numbers I already mentioned them. So let's jump right away into valuations. But before that, let me remind you, I'm just a YouTuber. I'm not a financial advisor. Just like I said multiple times, I don't even understand this industry, but I do like it, and so I would love for you, my community, to help me with this. Do your own due diligence. Do not make any decisions based on my opinions here. And so, yeah, let's jump into it. If we were to look at the multiple historical valuation, we're looking at what the market has been willing to pay, and we're looking to somewhere between $160 to $177. Right now it's at 218. So that is, it will, based on only this valuation, it will be overvalued. But let's look at the other ones. When we look at the revenue based valuation, we plug all the numbers for the last 5 years with a PE of 14. We're looking at a fair price of somewhere around $166. Discounted earning valuation, whenever we grow it, we're looking at 115 with a growing at a 5% with a 14 PE. Book value, payback time. This is it would be a 911. The best way to understand book payback time is actually using I'm going to use it in a different way. So right now it's $219. So if you were to buy it now, it will take you, somewhere between 4 and 5 years in order to get back what you put into it if you are just taking the free cash flow. So I hope that helps. So if we add up all the free cash flow, growing them at 10% in the next 5 years, the fair price is actually $260. Whenever we go and discount free cash flow, grow it at 10%, then discount it at 15% required return of investment, we're looking at a $328 fair value if we're looking at the trailing 12 months, or $275 if we're looking at the average free cash flow. Owner's earnings, I will not be using this because it just I don't have enough information. So as we just take those out, we're looking at an average fair value of $187, which is close to what the analysts are thinking that is a fair value. Now you could use the $196 trailing 12, especially since it has been growing pretty nicely. So that's the fair value with no margin of safety. If you wanted a 15% margin of safety, which is something that I regularly use for a company like this, we're looking at $167 as an entry point. And 167, that means that actually it wasn't too long ago there, back in October, back in November. So, 67, sorry. So that will be Yeah, somewhere around November 14. So that's my analysis. That's my thoughts. Please let me know what you think, what I got wrong, and then leave a comment down there, subscribe, and leave a like. And I hope to see you in the next week, in the next video.